Sean Haney here with RealAgriculture.com, and right now I am joined by John Dreger from Farm Like Marketing Solutions. How are you doing today, John?
I'm doing fine, thanks, Sean.
Hey, John, I'm looking at the Canadian dollar chart right now, and seems like a point of sort of a fork in the road, as you will. We've been as low as in the last year, as low as 68 and as high as 84. We're sort of sitting here up, mid upper tier 70s at 77.5 in the cash market. It really does feel like we could go either way. How do you look at this Canadian dollar right now?
Yeah, I think that's probably fair. I think if you ask a lot of people, Sean, they probably would sort of feel that we maybe have settled into a little bit of a range here, and where you might view, sort of that upside or downside risk as being, call it roughly equal, if you will. And so, as we look at it here, going forward, and I think we sort of have to take a little half step back and think about maybe where we came. And, if you look at when we traded to the lows there in mid-January of 68 and a half, and people had projections about, into the 50s and the lower 50s and who knows where. I mean, certainly things had gotten a little too pessimistic down at those levels, and it's always obvious in hindsight, but certainly at the time it sort of was where it probably got a little too low, and some recovery was probably in order. We had crude oil trading near its lows and so forth, and so then we've up rally, and really when you think about currency markets, that's a pretty aggressive move in a short period of time for markets as deep and liquid as currency markets are. And so we had this big run up, and now we've had this little pullback, and we sort of settled into a little bit of a range, and we've sort of been fairly benign the last little while. So as I think about where we're going from here, there's a couple of key things that we've been watching, and one of the things that we've really watched real closely is the U.S. dollar index. Now, just a little bit of background on the U.S. dollar index. It's a trade-weighted basket of six currencies. So the biggest portion is the euro, and then the Japanese yen. The Canadian dollar is a part of that basket. And it's so important because it reflects currency movements in general. It has an impact on commodity markets and so forth. So we had a U.S. dollar index that had been really strong, really kind of heading into the later part of the calendar year. And part of it is because the U.S. economy had been doing relatively better than most other economies in the world, ourselves included in particular, but also Europe and Japan. We ended up having a sort of a huge long position built up in this U.S. dollar index, and it really got heavily loaded on one side of the boat. And so as some of the economic news out of the U.S. was maybe a little less robust than people were looking for, we sort of had this ship that kind of just sort of tilted a little bit and rolled over. And we actually had some pretty aggressive selling of the U.S. dollar. From a fundamental perspective, not sure that was necessarily fully warranted, but maybe more a reflection of maybe just some shifts in sentiment. So, as we rallied up, it sort of coincided with a pretty steady and persistent grind lower in the U.S. dollar index. And so that U.S. dollar index really tested support and put in a little bit of a reversal here in early May, and has actually been strengthening here a little bit. And so backing that into the Canadian dollar, that sort of fits fairly consistently with where our Canadian dollar sort of peaked out and has now pulled back here and has been drifting in a bit of a sideways pattern. So, as we think about here going forward, I think with the Canadian dollar, we maybe broke a little bit of a shorter-term trend line support to the downside, so that would maybe point to perhaps a little bit of weakness going further ahead, and also particularly if the U.S. dollar continues to strengthen. At the same time, we also have seen crude oil, gold, and some of these other commodity markets trade with a bit of a firmer tone. I think from an outside speculative money perspective, there's a little more appetite to own commodities, crude oil, grains, and some of those markets, and that has a positive influence on the Canadian dollar. So I think as we sort of weigh some of the different big tectonic plates that are shifting around out there, I think probably a bit of a sideways, maybe a bit of a softer tone would be how we would view the Canadian dollar here going forward, as we sort of take a bit of a step back and look at some of these bigger picture things. Our economy is still a little bit on the softer side. That's not great for our dollar. U.S. economy is still relatively stronger than the Canadian economy is, so that would be, point to maybe a bit of a softer dollar. But then within that, of course, we've seen quite a bit of volatility one day to the next as well. And even some of these stretches where you look back and say, we've sort of gone sideways. But within that, we've had some days where we've been aggressively higher, quite sharply lower, and even though it hasn't gone anywhere, looking back over a period of time, it's chopped around a lot one day to the next. So those are some of the bigger picture things that we look at here as we think about where we're at and then potentially where we're going in the months ahead.
Yeah, every 2 weeks we do an interview with Ann Wasco, the beef market update, and actually earlier this week we talked to Brian Perlat from CanFax. And the theme of 16 is definitely, it's been an ugly period for the cattle feeder, and as of late, since February or mid-January, a big piece of those $500 a head losses has been this rise in the Canadian dollar, and it's really impacted producers. And sometimes people don't necessarily think about that as this dollar's going up. We think about how it's becoming cheaper to buy that U.S. vacation property, but also it's dramatically impacting producers negatively as well.
Well, no question, and I think it's also the sort of the speed of that move. I think in many cases, whether it's cattle feeders, grain farmers, or anybody in any kind of exporting or importing industry, I think in a lot of cases businesses can handle shifts in currency if it's somewhat orderly and over a period of time. When it happens fairly aggressively, it doesn't matter what your business is. It just makes it a lot more difficult to adjust to those shifting winds. And thinking, for example, something like wheat basis levels and some of these other factors that work into grain farmers or whatever industry you're in. If you're impacted by the currency, obviously there's that direct impact in your business. But again, the speed and the magnitude of it over that short period of time, particularly when there was so much negative sentiment at the bottom, which again in hindsight is always obvious, but that certainly was abrupt, and no doubt it's difficult for any business to really transition to such an abrupt move. And as you say, it's not sort of that headline number in the sense of cattle prices are up or wheat futures are up. It's such an important aspect of those values that farmers receive, and yet it's almost a sort of an undercurrent that's behind the scenes in some ways a little bit.
So no secret to anybody, the Canadian dollar is often referred to as a bit of a petrocurrency, meaning that it's immensely tied to energy prices. Does it surprise you at all that we haven't seen much movement in the dollar with some of the devastating impacts that have happened in Fort McMurray with the forest fires? Obviously, there has been a disruption in oil output per day on a barrel basis, and really we've still continued that kind of side trade of the dollar.
Yeah, I think if you look at crude oil, I mean, certainly there's been some disruption, obviously here in Western Canada with the tragedy we've had here in our own backyard. But if you look from a global oil market perspective, it's just one part of one moving part of so many different ones, and certainly that's helped lend itself a little bit to some firmer oil prices. But there have been a couple other stories too that have sort of helped contribute to that around the margins, maybe some disruption in Libya and so forth, some other places. So certainly that so while oil is sort of pushing some newer highs, we have pulled back here a little bit in the Canadian dollar. I think if we continue to see the Canadian or the crude oil prices run higher, I think you maybe will start to see the Canadian dollar catch up a little bit. I think if you look over periods of time, certainly you see that connection between the Canadian dollar and crude oil. But again, there are multiple moving parts. And if you think, for example, as important as the energy industry is to the Canadian economy, for example, I think it only constitutes about roughly 10% of GDP or something like that, give or take. So it's there's all these other multiple moving parts that factor into it as well. And one of the long-term real key drivers for relative currency rates is interest rates. And as long as there's sort of talk about maybe rates going up in the U.S. and our economy is a little on the softer side, we're probably not going to raise them anytime soon. That creates a bit of a headwind. So you sort of have some somewhat offsetting effects maybe as well, and maybe that's reflective of a bit of a turning point, maybe a bit of a range-bound trade as we go forward here.
Okay, John. Well, I don't know if you play roulette, but when I go to the casino, I like to play roulette. And one of the ways that when you're down in roulette is to catch back up, is to bet either all your chips on red or all your chips on black. So we're gonna have a little currency roulette here, and I'm gonna ask you, would you go all in on seeing in the next 6 months 84 or 68 again?
Well, those are some extremes. If I had to choose one or the other, I think would probably be 84 before 68, because you're looking at a pretty aggressive move lower relative to a little more modest move higher. But if I had to guess, if you said higher or lower, I'd probably say we drift a little lower from here. But 68 is a pretty aggressive move to the downside. I think we got a little too pessimistic down at those lows, and you could probably back that into, for example, crude oil and some other markets as well. 84 is probably within the range that some feel maybe is the sideways range where we trade. I think that's probably a little on the high side. But I do think those extreme lows are behind us. But I'd venture if you tighten up that range, I probably would put towards a bit of a softer tone here as we go forward, but probably not aggressively lower in the sense that we saw this real sharp move into the tail end of the calendar year of 2015.
Well, as I look at the chart here, the one-year chart in the cash market, we see a little bit of a range at about 70, between 72 and 73. So we'll say that that's where you're putting your chips.
Yeah, I think that's reflection as we again sort of consolidate around some factors and some aggressive moves, crude oil, some other markets, and that's I think a fair scenario here as we go forward, barring some major economic shock or something like that.
Okay, John, thanks a lot for joining us today, and we'll talk to you again, I'm sure, very soon.
Always a pleasure. Thank you.